We previously discussed how the market is interconnected. We looked at different markets to understand and piece together the puzzle. Now we will discuss the major economies. The major economies will trade their currencies and we will study each country. Now we will read their basic facts and figures. Their economy will have an overview. We will understand how their central bank manages the currency and what makes their currency unique and which economic indicators are important to watch. How those pairs are traded, what is the nature of the pairs. We will cover everything step by step. So don't panic, guys. Let's go ahead. First, we have the United States, an economic giant, 24% of the global economy. It is the largest economy in the world. It has highly efficient major industries in global markets, diverse and the strongest. Its sector is the services sector, not the manufacturing sector. It runs a trade deficit. It imports more. So what are the economic indicators of the US? NFP, non-farm payrolls, because the changes in the farm are seasonal. They are not added. Measures are money jobs added and lost, then GDP is measures overall size and growth of the economy. Retail sales show how much consumers are spending. CPI shows how much is the inflation. Retail sales also indicate how much people are purchasing. PCE is personal consumption expenditure. This is also a measure of inflation like the CPI, but the CTAI is what the market, the traders and Wall Street look at. The Federal Reserve of the United States. Its focus is more on PCE, personal consumption expenditure. While both measure inflation, the University of Michigan gauges consumer confidence, whether consumers' expectations for the future are good or bad, how they feel, or what the economy will be like in the future. The dollar is said to dance. When gold goes up, the dollar goes down, and when gold goes up, the dollar also goes down. When the dollar goes up, gold goes down. But this is another collusion which is now not in effect, so it keeps on changing. Economic news from the US. Good news helps the dollar. If there is good news, the dollar becomes strong and trade deficit. How much money is coming into the US? How much money is going out of the US? The more money going to the US, the better for the dollar. Big events, the major events happening in the world, especially geopolitical wars or situations that create trouble, create insecurity, which make people uncertain about what will happen in the future, what happens because of that. Bond yields affect the dollar. Higher yields in the US compared to other countries attract investors, as we discussed. When bond yields are higher, investors from other countries will rush to invest in dollars because it is a safe reserve currency. It is also a safe haven, so people will prefer it. And the biggest driver of movement is the expectation of what the next path of the Fed's interest rate will be. Whether it is up or down. If the rate goes up, the dollar will be strong. If the market expects it to go down from the Federal Reserve, it will be weak. Trading the dollar is basic. USD can be the first currency in any currency pair. It can be first or second. In dollar yen, it is first. It is the best currency. In Euro USD, it is the quote currency. Traders buy and sell. We discussed that a lot consists of 100,000 units, 1,000 units. Then it is measured in pips. We have discussed this as well. Traders have to invest their money. In margin, we have to trade the dollar. We have to compare its economic data with the economic data of other countries. Keep an eye on the dollar index. Analyze its price action and technical analysis. Pay attention. Keep an eye on what the Federal Reserve or its members say, what comes in our economic calendar.